Hi everyone, we're here at the PDAC 2022 Mining Conference in Toronto, Canada, the biggest conference in the world, and we're very happy to have with us Jeffrey Christian of the CPM Group. You finally made it. Long lines. It's been busy. It's buzzing, which is great to see after so many years. Well, seems like forever.
They're now doing crowd control, limiting the number of people coming in.
Interesting. That's unbelievable. And you were there for an hour and a half or hour, something like that?
An hour on the express line.
Jeez. Okay, well, let's get to it. Let's talk about, first of all, you're holding your gold book. And this is for this year, 2022?
This is the 2022 gold book.
Okay. And when did this come out?
We produced this one in April. We normally come out in late March, but we did it in the first week of April because of scheduling issues this year. And then we did our silver yearbook in the first week of May, and we'll do our platinum group yearbook at the end of July. Okay, great. And somebody can just visit the website to kind of... You can visit our website and you can purchase these. These are like our loss leaders, so they're $160 each, and they're like 200 plus pages of basic supply-demand data. Okay. Everything you really need to know about gold or silver or platinum group metals. Okay, great. Well, Lee, let's talk about the market. And the market's been very interesting these last few years, especially during the pandemic. I mean, it's just been so volatile, but very interesting to watch. You made some very interesting comments recently, actually, about this electrified future that we're all supposedly facing. You think, actually even specifically looking at the fundamentals of silver and some other metals, that based on consensus estimates, it's it's quite exaggerated in your opinion from what you mentioned in the market recently. Why is that? Well, you have to you have to define who's in your consensus.
Right.
I think a lot of people who are promoting silver and copper and lithium and/or their mining companies have been overly enthusiastic in their projections, and so you'll see people talking, for example, with silver, how a typical petroleum-powered vehicle might use an ounce of silver per car right now, but an electric vehicle is going to use 7 ounces. Right. In reality, an electric vehicle will probably use 1.5 to 2 ounces. So it's a significant increase. It's a doubling of the amount of silver per vehicle, but it's not a 7-fold increase. Right. So there's a lot of hype going on, and there's also a lot of optimism, over-optimism about how fast we can move to an electrified future. Because there's not enough high-purity manganese sulfate, high-purity cobalt sulfate, lithium, nickel, and other metals to do this, and there are not enough manufacturers of electric vehicle motors. Right. And there are major capital constraints that are keeping a lot of those component and raw material manufacturers from building their capacity. So you look at these projections for how fast electric vehicles will be taking over the auto market, and you say there's just not enough components and motors and raw materials to meet that need. And you talk to government officials and CEOs. Well,
I was just about to mention about, and
they say, well, people will build those mines. Right. But they don't realize, it takes a year or 2 years to build an auto factory to build electric vehicles, but it takes 10 or 20 years to build a mine. Right.
But how about items outside of that, such as infrastructure development, things like that to support that system? Are those maybe some hurdles as well that could be slowing the electrification?
Absolutely. I mean, there's not enough electricity. Even today, with 16 million electric vehicles on the road worldwide. Right. We are having blackouts and shortages and grid failures in the United States, in other countries. I mean, there's not enough electricity to meet the need. There's not a stable enough grids to supply that. Right. And then there's not enough raw materials, and there's not enough capital to supply that raw material. Right. Yeah. And then you've got some other issues down the road, which is at some point consumers are going to realize electric vehicles don't necessarily sharply reduce carbon dioxide emissions. Yeah. They move them from the cities to where the power plants are. Right. Because if you look at the International Energy Agency's projections, in the year 2050, 30 years from now, petroleum will still be our major source of energy. Interesting. Okay. Natural gas the second. Coal will have fallen to 4th place after 2040. Right. Compared to all renewables combined in Turkey. So we're going to be. And how about nuclear? Nuclear, that's a real problem, because nuclear actually has a great potential to help us with carbon reduction, but it's flatlining in the IEA projections, and the IEA projections reflect the reality of what's going on. People are not looking at nuclear as much as they should, and they don't realize the extent to which the nuclear power industry has radically transformed itself over the last 40 years.
Interesting. Okay, well, let's talk about the macro picture then. Let's talk about watching more specifically to do with the U.S. Fed. You're seeing a lot of inflation worldwide. We're just talking with someone else just before with Peter Kraut and talking about inflationary risks, stagflation. I mean, it's just a bad recipe. So, what is going on here, and can the U.S. Fed really lead the way to resolve this inflationary issue that we're all facing?
Yeah,
are they doing the right thing?
I'm really astounded by the lack of knowledge and information and accurate analysis pervasive throughout the market, not just the metals market, the money market.
And how so?
There's so much misunderstanding. First off, to compare where we are today in terms of monetary policy and everything else to the 1970s is to completely miss some very important changes that were introduced really starting in October of 1979 when Paul Volcker took over the Fed. And monetary policy today is not at all what it was in the 70s. And governance is not what it was. In 1979, we had a $58 billion federal deficit, and we had less than $1 trillion in debt. That's radically different from where we are now.
Of course.
So it's you just don't get any useful insights comparing now to the 70s. You have to look at where we are. I happen to think the Fed's doing the right thing. They got slow off the mark on the inflation. We've seen inflation high now since March or April of last year. In January and February of last year, inflation in the United States, US CPI, was like 1.6, 1.8%.
Interesting, okay.
And the Fed was saying inflation's too low. So then it started rising in March and April. So we're like 14 months into an inflationary period. And people are comparing that to 14 years of 5 to 14% inflation in the 70s. That's not a fair comparison. They're talking about hyperinflation, and real economists define hyperinflation as 50% increases per month. We're nowhere near that. And in fact, we've never been near that. In the 70s, we had 5 to 14% over 10 years, and that was a bad inflationary environment. And we're nowhere near that.
So then if it's not as much as a concern now compared to those periods in the 1970s, how about all this talk about recessionary risks? Is that still on the table based on today's current environment, or is that probably something that's baking in but it'll take much, much longer to be realized?
There are recessionary risks, and we've been projecting a recession for 2024, 2026 for several years now. So it's several years down the road, although it could come sooner. I don't think that, if I look at what I think could cause recessionary risks, Fed policy is not high on my list of potential causations. And I think the Fed is much more aware of underlying inflation than any of the guys that you're seeing, waving their arms, talking about hyperinflation.
Interesting. Okay. So what are central banks doing in this situation?
Well, central banks are...
we've seen them buy gold during inflationary periods, and or when there's a black swan event such as that. But what are they doing now? Well,
central banks have been buying. They were buying some gold, increased amounts of gold last year because the price had risen sharply in July and August of 2020, and then it came down. And that was a very important factor because what you saw were central banks that used to say, I'm a buyer at 1,200, 1,300. They were buyers at 1,800 last year. So they're saying, from a long-term perspective, we think 1,800 is a cheap price.
Interesting.
And we're almost at 1,800
we're 1,840 this morning.
So central banks are interested in adding gold to their portfolio, but that's a relatively minor factor.
And which countries were some of these central banks buying? Like, was it some Russia, or was some of the smaller countries? Because it can also depend, right? I mean, on the amount of these purchases, how big these purchases are, who's repatriating the gold back, et cetera, that makes a significant difference.
Russia buys gold for reasons different from all other central banks. And Russia hasn't bought any gold since March of 2020 because it is so dependent on oil and gas exports.
Right, yes.
And then they get dollars and euros, which they were using to buy domestically refined gold.
Right.
When the oil and gas prices fell in March and April of 2020, they stopped buying gold, and they haven't really resumed purchasing. One of the interesting aspects of last year's gold purchases by central banks was you saw more central banks buying gold that were not traditional gold buyers.
Right,
so
okay.
You're seeing a diversification, more central banks saying, yeah, we want some of our reserves. We're not looking to build massive gold reserves, but 1 or 2% or 3% of our monetary reserves in gold. So you're seeing more central banks buying gold, which I think is very positive for gold on the long run,
right,
combined with the fact that they're buying it at a higher price.
Interesting. Okay, so let's talk monetary policy then here. It's interesting to see what other countries are doing to address their inflationary concerns. You're seeing U.S. take an aggressive front for quantitative tightening. You're seeing China do the complete opposite, quantitative easing as of the last 6 months. Why the different approaches? I mean, there's several reasons for that, but what's your take on what's going on with some countries that are implementing their monetary policy?
China has a number of domestic issues that we don't have.
Yeah.
And they have domestic issues that they don't necessarily air on television the way we do.
Right,
So people don't necessarily see the rationale behind Chinese government practices. But the Chinese government, I think, is much more concerned about recession than it is about inflation. And the United States government is saying, well, we don't want to throw ourselves into a recession, and we think we can avoid that.
Right.
I'll get back to that in a second.
Okay.
But they think we can avoid recession. They're much more worried about, on a short-term basis, quelling inflation. As I said, it's been 14 months of high inflation now, and this is when you kill it, if you can.
Yeah.
You don't wait 5 years the way the government did in the 1970s. So you try to kill it now. So the Fed is much more concerned about inflation, and they think, again, go back to interest rates. You had 21% interest rates in 1979, 1980.
Right.
Yeah, that threw us into a recession. We have seen interest rates go from 1% to 3%.
Right.
And at 3%, they're lower than they were at any time prior to, say, 2019. So
Interesting.
the Fed feels it can raise interest rates a lot from a very low base with negative inflation-adjusted interest rates still, that they think they have a lot more capacity to raise interest rates without killing the economic expansion, whereas the Chinese are much more concerned about keeping the country out of a recession,
out of recession.
because that has political consequences that are far worse for the Chinese government than inflation.
Interesting. Wow. Well, that's a great way to wrap up. I really appreciate it, Jeff, for the interview here. Any last words on your CPM Gold book? Any projections for the gold price over the next year?
Well, our expectation had been that we'd see the gold price weaken over the second and third quarters, and we're definitely seeing that. I will point out that, and we've written reports that for our clients, silver and gold were the top performing assets in the first quarter.
Right.
7.6 and 6.6% increases over the first quarter.
Right.
The next best was cash at 0.6%, and everything else was negative.
Right.
Now, the second quarter and third quarter, everything else is suffering too, but gold and silver suffering with them. We think that beyond, say, the third quarter of this year, you start to see a revival of investment demand at higher levels for gold and silver, and that will be reflected in higher prices.
Interesting. Well, very interesting. If you want to find out more information, please visit cpmgroup.com, and you could contact Jeff directly if you have any questions, and to find out more information about their CPM annual books on all the metals, especially the gold. So, thanks, Jeff. Appreciate it, and we'll talk to you soon.
Thanks.
Right.
Bye.